Okay, let's dive right into today's explainer. Today is August 20, 2026, and we're stepping into the shoes of a Tier 1 global investment bank research desk. We're going to unpack what we're calling the sovereign debt Mobius strip. It's this fascinating and honestly kind of contradictory structural loop driving today's market. Basically, we're seeing aggressive monetary interventions fueling the exact same risk-on appetite they were actually intended to stabilize. If you've been watching the charts today, you know things are moving incredibly fast, but we're going to peel back the layers and track the actual institutional capital flow.
Here's our roadmap for the breakdown. First, the risk-on market explosion. Second, how Treasury buybacks are fueling liquidity. Third, unpacking the data divergence. Fourth, crypto's structural pivot. And finally, the strategic action plan.
Starting right off with Section 1, the risk-on market explosion.
Now, we absolutely have to talk about this exact price point. Bitcoin just smashed right through the $72,000 barrier, touching an incredibly precise $72,485.00. Listen, this isn't just some random fluctuation. It's the highest level we've seen since early June, and it represents a massive recovery rally for the digital asset space that's effectively dragged the broader risk-on sentiment right up with it.
But how did we actually get here so fast? Well, the mechanics behind the spike really come down to a staggering $3.1 billion in short liquidations. Talk about rocket fuel for a market surge. When you have billions of dollars in over-leveraged short positions just getting completely squeezed out in a matter of hours, it creates this violent, forced buying loop that just propels prices straight up.
And man, you can really feel the heat on the ground right now. Take a listen to this quote from the Binance Square community. "Risk on is back. Nasdaq just slammed the door on bear case talk. This is the kind of tape that crypto traders live for." That right there perfectly captures the intense, almost visceral retail euphoria dominating social channels today. The general vibe is that the bear case is completely dead and buried. But putting our institutional analyst hats on, we have to ask the hard question. Is this a fundamental shift, or is it just a mirage?
To figure that out, we've got to look at the cold, analytical reality of our macroeconomic foundation. And the crucial takeaway here is that inflation remains stubbornly sticky. When we pull the Federal Reserve economic data, FRED, core CPI is sitting at an elevated 336.79 and core PCE is right at 130.27. Why? Because the underlying components just refuse to cool down. Shelter costs are stuck up at 429.10, used cars and trucks bouncing back to 180.31, and crucially, services less energy have climbed up to 445.62. These three specific components are heavily padding those headline figures. So think about it. We have persistent inflation, yet the market is ripping higher, which brings us to the actual catalyst.
Moving to Section 2, Treasury buybacks fuel liquidity.
Let's walk through the exact chronological sequence of macro events that fundamentally shifted global risk appetite. On August 19th, the U.S. Treasury announces it's doubling its 10 to 30-year bond buybacks, raising the limit to at least $4 billion per operation just to support the bond market. That very same day, we got some political catalysts, with Donald Trump pushing the Senate to pass the Crypto Clarity Act, injecting a huge dose of regulatory optimism. Then, the very next day, August 20th, boom, that $3.1 billion short squeeze triggers, coinciding perfectly with a massive $250 million USDC stablecoin mint on Solana. That's a massive signal of fresh capital entering the on-chain system.
So, what's the currency and yield response to all of this? The DXY dollar index is sitting at an incredibly strong 118.90. Normally, a strong dollar just crushes risk assets, but look at the yield curve. The 10-year and 2-year yield spread has actually steepened to a positive 0.50 percentage points. Meanwhile, the Treasury General Account, or TGA, is sitting on a massive balance of $953,612 million. What we're witnessing is a massive trickle-down effect. The Treasury's liquidity interventions in the long end of the curve are essentially acting as a shadow stimulus, completely overriding the traditional downward pressure of a strong dollar.
Let's move to Section 3, unpacking the data divergence. Okay, if risk-on is truly back across the board, small caps should be flying, right? Well, instead, the Russell 2000 is bleeding. It's down 1.34% to 2,992.43. And when you look across all 11 GICS sectors, it's practically a sea of red. Technology is down 0.29%, financials are down 0.92%. We're seeing even heavier hits in healthcare, down 1.87%, consumer discretionary down 1.61%, and consumer staples dropping 1.41%. Industrials down 1.20%, Materials are slipping by 0.19%, while utilities and communication services are both down exactly 0.57%. Out of all 11 sectors, only energy is up a meager 0.27%, alongside real estate creeping up just 0.20%. This divergence totally exposes severe concentration risk and tells us that traditional correlations are completely broken right now. The broader indices are just being masked by a few megacaps and these wild short squeezes.
Want more proof? Look at the high-yield option-adjusted spread, which is sitting right at 2.73%. This metric is absolutely essential for correctly judging the true risk-on appetite of institutional capital beneath all that index noise. At 2.73%, credit markets are relatively calm, sure, but they certainly aren't signaling the same euphoric breakout that retail crypto traders are currently celebrating. Which brings us to this incredibly sobering institutional perspective from Morningstar and the Motley Fool. They remind us that multi-year bear markets are common with cryptocurrency. Patience is a must if you invest in it. You really have to contrast that earlier retail euphoria with this measured view. Institutions know the difference between a short-term liquidity squeeze orchestrated by Treasury buybacks and actual long-term fundamental health.
On to Section 4, Crypto's Structural Pivot.
So, keeping all that in mind, let me read this next takeaway word for word because the phrasing here is vital. Bitcoin, BTC USD, is currently trading at exactly $72,485.00, marking a plus 4.65% increase from the previous day, signaling a distinct risk-on structural shift. That isolated signal is just incredibly powerful, especially when the rest of the equity sectors are bleeding out like we just saw.
And if we look at the commodity space for alternative signals, it gets even more interesting. Gold is soaring, sitting at $4,575.10, which is up 1.91%. Meanwhile, WTI crude oil is holding strong at $86.48 a barrel. Now, gold is flashing serious inflation and currency debasement fears, while oil is suggesting persistent geopolitical tension and energy demand. So if gold is out there playing defense, what exactly is Bitcoin playing right now?
Well, that brings us to a critical paradigm shift. For years, the traditional narrative was that Bitcoin is digital gold, a safe haven inflation hedge. But the current reality? Entirely different. Institutional fund managers are now treating Bitcoin not as a safe haven at all, but as a high beta growth asset. It's essentially acting as a massive sponge for treasury-induced liquidity. When the government turns on those liquidity taps, Bitcoin absorbs it faster and way more aggressively than almost any other asset class out there.
Let's wrap it up with Section 5, the Strategic Action Plan.
Here are the clear technical and fundamental thresholds you need to be watching right now. Scenario A, our bullish continuation, requires way more than just short covering. We need to see sustained spot ETF inflows that fundamentally break and hold above the resistance level at $73,227. Now, Scenario B, the bearish bull trap, gets triggered if this liquidity dries up and the price fails to hold the primary support threshold at $70,265. If we lose that level, the short squeeze momentum evaporates entirely.
But listen, as risk managers, we always have to respect the tail risk. What is the black swan event hiding in the wings here? Well, what if JP Morgan is right? They're warning that these massive treasury bond buybacks might completely fail to ease the pressure on the long end of the curve. If that happens, and the 30-year treasury yield violently spikes back up to 5.26%, the cost of capital skyrockets. That would instantly derail this entire liquidity-driven rally and absolutely crush high-beta assets.
Which leaves us with the ultimate verdict to consider. We've seen the stubborn inflation data, we've seen 11 different sectors bleeding while Bitcoin and gold pump, and we know for a fact the Treasury is flooding the engine room with buyback liquidity. So I leave you with this. Is what we are witnessing today a truly sustainable macroeconomic breakout or simply a liquidity-driven mirage just waiting to evaporate? Keep your eyes locked on those support levels and stay focused out there. Thank you so much for joining me for this explainer, and I'll catch you next time.